Did you know that with just a few simple strategies, you could save hundreds of thousands of dollars on your mortgage? Sounds too good to be true, right? Well, stick around and I'm going to show you exactly how you can do this. Welcome back, everyone. Myles Nowik here from the Nowik Mortgage team, powered by ND Mortgage. And today we're breaking down how you can build equity faster, pay your mortgage off sooner, and potentially save yourself hundreds of thousands of dollars in interest. We're talking about strategies that can be implemented at this exact moment. Whether you're on your first home, second home, or 10 years into an existing mortgage, these are things you can start doing immediately to allocating more cash in your pocket. And trust me, the sooner we stop paying the banks all that interest, the sooner you can start saving that money. By the way, if you were to pay your mortgage off, let's say immediately, what would you do with the extra cash flow? Let me know in the comments below. To start this all off, we really need to have a good understanding about how our mortgage payments work. But to keep this quick, we're just going to touch on the not so great reality about mortgage payments. At the start, you're going to be paying a lot of interest and not much towards the principal. For example, if you have a $500,000 mortgage at a 4% interest rate amortized over 30 years, your first payment, well, it's going to be comprised of $1,653 in interest and only $724 going towards your principal. This commonly puts people in a position where they're wondering why it feels like they're not making any headway with their mortgage, even though they've been paying for a couple of years. But as time passes, you pay down the principal and the amount you pay in interest each month is going to decrease. If we were to use that exact same example from before, on the 60th payment, you're going to be paying about $1,497 in interest and about $880 towards your principal, which doesn't seem like a massive difference. However, the key feature here is that any extra money you put towards your mortgage is 100% principal. There's no interest added, and it's applied straight to reducing what you owe on your mortgage. Let's dive a bit deeper into this. The magic of additional payments is that they go directly towards the principal, which means you're lowering your balance faster and saving interest over time. Just like with an investment account, time is your best friend here, but in a very backwards kind of way. With an investment account, more time is better, allowing that investment to build on compound interest. But with a mortgage, the longer you take to pay it off, the more it's going to cost you in interest. Now, just a quick reminder here, unlike our friends down in the United States, here in Canada, our mortgages are typically on a term, usually around 5 years. After that, it's time to renew and renegotiate. So while I wish I had a crystal ball, we'll assume for these examples we're going to talk about that rates remain steady over the full 30-year amortization. Keep in mind, rates commonly don't stay steady, like ever. But today we're just kind of focusing on some basics. So let's look at some examples. Imagine that previously mentioned $500,000 mortgage at different interest rates. Here's how it would play out over a 5-year term with a 30-year amortization if the rates never changed, which, once again, they definitely will. At 3% interest, you're going to be paying about $70,562 in interest over the course of 5 years, and about $257,085 over 30. At 4% interest, that's about $94,652 over 5 years, and $355,935 over 30. And at 5%, you're going to be paying about $118,916 over 5 years and about $460,645 over 30. As you can see, the interest rate plays a really big role in deciding what your payments are going to be and how much your mortgage is going to cost you over that amortization period. However, there is something significantly more important than the interest rate, and that's your product itself and your prepayment privileges. The reason I say this is most lenders are going to have very similar interest rates. You're not going to see a traditional lender offering like 3% with the other one across the street offering 5%. That would make it incredibly obvious on which lender to choose, and it would make that other lender incredibly uncompetitive. What you could see is slight differences, such as rates ranging from, let's say, 4% to 4.2 or 4.19%. And the big question is, what is the difference between those two interest rates? Because in some cases, it might make more sense to take the slightly higher interest rate if it comes with a better product with better prepayment privileges. You're also going to want to make sure it doesn't have stuff like a bona fide sales clause or a collateral charge or any of these other details. Fine print is crucial when it comes to your mortgage. And always remember, if they're giving you a discount on the interest rate, chances are they're doing something else too. So always make sure to read that fine print. If you don't have good prepayment privileges, it can really limit what you can do in the future. And remember, we're basing this off a 30-year mortgage. 30 years is a long time. In 30 years, I'm going to be 65 years old. Yeah, it's a long time. But if we can shorten that by taking advantage of your prepayments, it's not as big of a pill to swallow when signing for that mortgage. And as a slight example, one of my clients used the strategies we're going to go over, and now she's fast-tracked herself to paying her mortgage off 10 years early. This is just to help show how impactful some of these small changes can actually be. And the first strategy we're going to talk about is kind of a basic one. It's pretty common knowledge, but something that I think really needs to be talked about a little bit more. And the reason I talk about it is because we do an annual review with clients, and we commonly ask them, hey, can you increase your monthly payment towards your mortgage? Now, for an example, let's say you're going to increase your monthly payment by $100 a month. The original payment on that mortgage mentioned above at 4% interest is going to be about $23.78 per month. The new payment going to $24.78 because we've increased it by $100. Instead of paying your mortgage off in 30 years, you're going to pay your mortgage off in 27 years and 10 months. And over the 5 years, it's going to save you about $625 in interest, which isn't a lot. But the total interest saved over the life of the loan is about $30,114. Now, if we wanted to step this up a little bit and say increase our monthly payment by $250 a month, once again, that original payment, $23.78, would be increasing to $26.28, and you're going to pay your mortgage off in 20 years and 1 month instead of 30. And by doing this, you're going to save about $1,561 over 5 years and $66,369 over the life of the loan. Now, I know some people are going to be saying, I can't afford to increase my payments by $250 in this economy. And you know what? I totally understand that. We've all been there with budgeting, but it puts us in a position of understanding where we can say, hey, my income's increased. Am I able to allocate all or a portion of that extra money towards my mortgage? Or let's say we finish paying off a car loan. What would it look like if we took what we were paying on that car loan and allocate that towards our mortgage? Simple steps can really help you get ahead here. As mentioned, $100 a month, which is around $3.23 a day, can save you about $30,000 in interest and have you pay your mortgage off in a little bit less than 28 years instead of 30. Now, the next thing I want to talk about is just making simple lump sum payments to your mortgage once per year. So let's say with that exact same mortgage, we're going to make a $5,000 lump sum payment on, let's say, our second anniversary. So our 24th payment of the mortgage. You're going to reduce your mortgage amortization from 30 years to about 29 years and 6 months. And the total interest saved over 5 years is only going to be about $612, but over the life of the loan, it's going to be about $9,973. One thing to remember, many Canadian lenders let you make an annualized lump sum payment of 10 to 20% of the original principal without penalty. Prepayment privileges differ from lender to lender. Some are going to let you put down 20%, others 10, and some 15. They all have different prepayment options, and it's really important to explore and understand these options. And generally speaking, it doesn't cost you anything extra to have good prepayment privileges. You just have to pick a lender that's willing to work with you and your goals, and a lender that's actually just generally a good lender. Now, the third strategy I wanted to talk about is making bi-weekly payments, but not just any bi-weekly payments, the accelerated ones. If you look at your mortgage and it says you have bi-weekly payments, double check to make sure that you have 26 payments instead of 24. And the reason I say this is on a lot of commitment letters, you'll have a bi-weekly option and then a little box that says accelerated or non-accelerated. If you select non-accelerated, you're making 24 bi-weekly payments per year and you're not paying your mortgage down any faster. If you select accelerated, you're going to have 26 biweekly payments, which equals out to 13 full monthly payments, and that extra payment is 100% principal. My light just died. Oh well, but that's going to help you without cutting into your prepayment privileges. So let's say we take accelerated biweekly payments on that previously mentioned mortgage. You're going to have your mortgage paid off in 25 years and 11 months instead of 30. And it's going to save you about $1,389 over 5 years and about $56,000 over the life of your loan. Another thing to consider is how you can stack these prepayments on top of each other. For example, a lender that I commonly work with has the ability to double up your mortgage payments. And recently, my lender rep even told me you could take that double payment and increase that by the 15% they allow you to increase your payments by, putting you in a position where you could pay things off incredibly quickly, depending on your goals and strategies with your mortgage. Sometimes knowledge is power, and it turns out power is your prepayment privileges. Now, here's a little bonus thought that's sometimes overlooked. If you're paying your mortgage off early, you're not just saving on the interest. You're eliminating entire chunks of time where you won't need to pay interest at all. Imagine knocking 5 years off your mortgage, and let's say those 5 years cost $42,000 in interest. That's $42,000 in interest you don't have to pay. Plus, considering the overall interest saved over the life of the loan from the strategies mentioned earlier by making extra monthly payments, lump sum payments, or using an accelerated payment plan, you could save tens of thousands, if not hundreds of thousands in interest over the life of your mortgage. To sum this all up, making extra payments, lump sum payments, or switching to an accelerated payment plan are all ways to get ahead of your mortgage. And the faster you pay it off, the more you're going to save. One question I'm commonly asked, though, is should I be taking extra cash flow and paying my mortgage off early or investing that money elsewhere? And that's a really great question. For example, if you take that $5,000 lump sum and apply it to an RRSP, and you're going to take the tax return from that RRSP investment and apply that to your mortgage while earning compound interest on that investment, you know what? I think I'm going to save that for another video, or I'm going to be talking for another 10 minutes. Now, if you are curious about compound interest, I'll make sure to put a link to a video I did earlier in the description, or you can click right here to learn more. I'd love to hear from you though. Are you planning on paying your mortgage off faster? Or do you have some secret strategy that's working for you that we didn't talk about in this video? Make sure to drop it in the comments below. And if you got some value out of this video, don't forget to like and subscribe. Once again, my name is Myles Nowik of the Nowik Mortgage Team. Thanks so much for tuning in. We'll catch you on the next one.